This is serious. I'm your host, Steve Van Metre, and thanks for joining me today. And what's going on in the global oil markets right now has the potential to destroy the American way of life. Now, as the global reserve currency, the US dollar is used in trade all throughout the world. And what a lot of people don't understand is the number one export of the US is dollars. And when you're the global reserve currency, your role in the world is to make sure there's enough of your currency for everyone else to conduct trade with it. And so in the case of the dollar and the United States, our role is to make sure we export enough dollars to the rest of the world. And in turn, they take our dollars, they conduct trade, they buy our debt. And what this means from a monetary perspective, now, I know several of you will disagree with me when I say this, is we need to run persistent and ongoing deficits. Now, I'll quantify that in a moment, but the notion is we need to run deficits to make sure there's a constant supply of dollars being generated through the debt mechanism to supply the rest of the world. Now, what we can argue about and perhaps agree about is what we use that debt for makes all the difference. But if something were to come along and disrupt this flow of dollars, or stop the notion that people want to use the dollars trade, well, it has the potential to destroy the American way of life for one very simple reason. It's because foreigners buy a large percentage of our debt. And if they stop using our currency and stop having demand for our debt, well, that means the US government would have to go from running these deficits to surpluses, and our debt would have to be bought by American citizens. And so what this potentially now puts us in play for when we start looking at what's going on in the global oil markets, particularly what China's up to and what Russia's up to, when I don't want to suggest that the current administration or any administration in history is rooting for a recession, but what I want to suggest to you is we may need a global recession, because if we have something different, such as a global expansion, well, the cards are already being played to usurp the dollar as a global reserve currency and bring America down. Now let's head over to CNBC, where we picked today's story up. With the headline, the U.S. begins buying back oil for the Strategic Petroleum Reserve. Now, of course, we knew this has been coming because the U.S. Energy Department said on Friday it will begin buying back oil for the Strategic Petroleum Reserve, or SPR, the first purchase since this year's record 180 million barrel release from the stockpile. Now, I know a lot of you disagree with the fact that we did that. I'm not saying it was right or wrong. Of course, we know that the Biden administration released oil from the reserve to bring down inflation. I want to give you an argument. I'll give you a reason why they're going to try to pull this off and come out ahead, but let's continue on before we get to that. The department will buy up to 3 million barrels for delivery in February, which is literally a drop in the bucket of the 180 million it was drained. But perhaps what will help is we now see last week crude oil inventories, looking at the EIA data, jump 10.231 million barrels. So perhaps there is, or we are moving in a position where there's oversupply, and this will be a benefit to the government. President Joe Biden announced a 180 million sale late March to combat surging gasoline prices that boosted inflation after the February invasion of Ukraine by Russia, the world's largest exporter of fossil fuels. Save that for a little bit later in the show. The sale shrunk levels in the SPR to about 380 million barrels, their lowest since 1984, raising concerns about energy security. And of course, and that is what the SPR was designed for, was to give us energy security, even though we've seen in the past presidents have used the SPR as a means to bring down or attempt to bring down inflation. But what you can see here is the idea is the Fed is actually aggressively tightening. We've talked about this in recent shows and are likely to send us into a recession. Now, in a recession, of course, we know oil prices go lower, but what we see here from the Biden administration is, hey, let's fast track this inflation mechanism and bring it down at a time the Fed's over tightening. We'll draw the economy into a recession. Of course, oil prices then come down and we can buy it back at a cheaper rate. Now, again, I'm not suggesting that is their game plan, but you can almost see how this is going to play out. will be releasing a solicitation to purchase 3 million barrels of oil for delivery in February of next year, 2023. Contracts will be awarded to energy companies by January 13th, and this approach will lock in a price up front when companies submit their bids. Now, I want to give you another argument for this of why, of course, they're doing the way they're handling with these repurchases, because let's say we do end up in a recession, which again is my base case given the history of central bankers over-tightening monetary policy and the fact that we're coming off all of this pandemic and monetary stimulus. And you look to the oil markets, which are large employers. They employ a ton of people, and the money flowing out of these oil companies around them to support it also employ a lot of people. So in a recession, what we normally see is oil prices tanking, and this could put a floor, or at least an artificial floor, and keep Americans at work, which could be a big benefit. But how we're going about this, well, I'm not sure I agree with it, but it's what we're doing. The White House said in October it would buy back oil for the SPR when prices were at or below 67 to 72 a barrel, which are not there yet, where the U.S. benchmark futures were trading on Friday at about 75. Maybe perhaps the White House knows prices are going lower, or maybe they're just hoping. We're going to try to be nimble and flexible here, the official said, adding the department likes where prices are now for exploring buybacks. Perhaps a key word there, exploring buybacks. Now let's take a look at what's going on with China, because the setup now so far is we've got to refill the strategic petroleum reserve. We're going to do it at micro drops at a time. And again, this is like the Fed saying, hey, we're going to start doing some tightening, and to tighten, well, we're going to scale back on our easing, right? This is just nothing. They're doing 3 million barrels out of 180 million draw is absolutely nothing. But the timing of this is what I want you to see. Is now we looked first to China, and let's look to Russia. China and Saudi Arabia stress importance of oil market stability since Xi Jinping revisits Riyadh. Of course, we know this going back a little bit, as the People's Republic of China welcomed the kingdom's role as a supporter of the balance and stability in the world oil markets as a reliable major exporter of crude oil to China. A joint statement was published between Riyadh's state-owned Saudi press agency. China is the world's largest crude importer, while Saudi Arabia is the greatest exporter of such resources and chairs the influential OPEC Plus Producers Alliance. So, of course, we know that what's called the petrodollar kind of started with the deal with Saudi Arabia between the U.S., where we effectively said, hey, we will be your defense mechanism. In exchange, we want you to price oil in dollars. Well, of course, now China's coming along, and they have a dollar shortage. Now, we know this. We've talked about this. So what does this mean? Is China going to be paying in dollars? No, they're going to be paying in yuan. Now, the question is, you should ask is, does Saudi Arabia really want yuan? Well, probably not so much. Of course, China will say, look, we're this big manufacturing base. We'll buy some oil from you, we'll pay in yuan, and then you can come back and buy stuff directly from us in yuan. Now, the issue will come to be is, does Saudi Arabia want to hold excess yuan and turn around and buy Chinese bonds, just like they take their excess dollars and buy U.S. treasuries? Well, probably not. President Xi met King Salman bin Abdulaziz Al Saud and his heir, Crown Prince, and Saudi Prime Minister Mohammed bin Salman, according to Chinese news agencies. The talks so far have resulted in the signing of a comprehensive strategic partnership agreement and 12 agreements and memorandum of understanding in topics including hydrogen, direct investment, and economic development. Again, and all this is doing, and maybe perhaps in a very small way, is just redirecting some of this demand for dollars that the U.S. would be supplying to the world, and now redirecting it to yuan. Now, again, not a lot of people want yuan. In fact, a lot of Chinese people want to get rid of it, want to get their money out of the country into something else. But I want to suggest to you, just from this little bit of what's going on between China and Saudi, that there is the beginning of perhaps a change from the demand from dollars to other currencies. And now let's take a look at what Russia's doing, because they have the ultimate ace card that they could play. If Russia accepts gold for oil, gold price doubles to 3,600, says Credit Suisse's Zoltan Pozar, notably one of the foremost experts in the global monetary system. He says in a year of unthinkable macro scenarios that it is not improbable for gold to double to 3,600 an ounce if Russia responds to the G7's oil price cap by accepting gold for crude. Now, you may not know this, but over the last couple of years, Russia has divested itself of U.S. treasuries. It used to hold them as part of its reserves and holds almost none, or at least very little compared to what it held before, turning to gold. So now it's building up a big stockpile of gold and now can command the market. So imagine for a moment if Russia says, hey, wait a minute, U.S., you need some of our oil because, well, there's actually a big demand for it. The U.S. economy is booming. The global economy is booming. Saudi Arabia is over here selling some stuff to China for yuan, and you've drained your strategic petroleum reserve to get inflation down, and now you need some cheap oil. Well, guess what? We don't take dollars here, but what we will take is gold. In this scenario, Russia's President Vladimir Putin responds to the recently introduced $60 a barrel oil price cap by asking for a gram of gold or two for 2 barrels of crude. At current market prices, the cap is $60 per barrel for Russian oil, equals the price of a gram for gold. What essentially happens here is the U.S. pegs Russian export at this price, and Russia in turn pegs it at a gram for gold. And this would come at a time when the U.S. is working to refill its strategic petroleum reserves with cheap petroleum. So imagine this, all of a sudden you see the U.S. in a dire situation to get oil, and all of a sudden has to drain its gold reserves. Now, of course, we know the dollar is not backed with gold anymore. Those days are gone. But there is, kind of a soft peg that there is some value behind if things went wrong. Well, imagine now the U.S. is draining its gold reserves. What would that start to mean for the dollar? In this example, the U.S. dollar effectively gets revalued versus Russian oil, but if the West is looking for a bargain, Russia can give one the West can't refuse, a gram for more. If Russia countered the price peg of $60 with offering 2 barrels of oil at the peg for a gram of gold, gold prices double, and this is how gold can get to 3,600 an ounce from the current level of around 1,800. And for those of you who hold gold miners or resource plays, of course, this would be welcome news to see such a surge in price. But of course, this would come at a cost of a weakening dollar. Now, keep in mind in global trade, where we started today's show out, is you want stability in your currency. And this is why other currencies such as the yuan are not widely used, because they fluctuate too much. Because if you're in the middle of a transaction and the currency you're receiving goes down in value, well, that's not actually a good thing. You want it to hold its value, or ideally even maybe appreciate a little bit. Russia won't produce more oil, effectively keeping the U.S. at a point where they're forced to buy, because it would ensure there's enough demand that production doesn't get shut, and would also ensure that more oil goes to Europe than the U.S. through India. And most important, gold is going from 1,800 to close to 3,600, would increase the value of Russia's gold reserves, which has ramped up incredibly over the last couple of years, and its gold output at home in a range of countries in Africa. So here you can see Pozar making the case that Russia is playing the long game here and setting up, and they're hoping that things in the U.S. actually play out to their advantage. So now you see why earlier I mentioned that a recession actually would be ideal to starving this off, because if the global economy booms, well, the U.S. is going to need oil, and Russia's got the cheapest around. If Saudi is redirecting business over to China, they've got it, we'll need it. But if there's a recession and oil prices tank, and there's too much supply, well, then it all comes out, and this scenario doesn't happen. Putin hit back at the Western sanctions on Russia oil by vowing to deepen trade ties with China and other allies. Already, the limitations have caused Russian crude exports to nosedive, spelling trouble for the nation's economy, as crude oil is one of Moscow's biggest money makers, as 90% of the supplies have been redirected to Asia, but even at steeper discounts, with oil regularly being sold below the level of the price cap. And Putin has rebuffed the oil price cap as stupid and has threatened to retaliate by refusing to sell Russia supplies to participating countries. But cutting itself off from Western markets could wither Russia's economies long-term, economists say, with Russia's central bank warning that the latest round of sanctions were already economic shocks to the nation. And perhaps that could be the card that Russia plays. You've backed us into a corner, America, and now we've had enough. And so if you want oil, you'll pay in gold. And so now you can see what's playing out in the oil market has a direct potential threat to the American way of life. But if we have a global recession, well, none of this will happen. But if we turn out and have a big booming economy and Russia's economy slows or even collapses, well, don't be surprised if they play their card, because they certainly can do it. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.